The US is finally giving the crypto industry a fair regulatory framework. The House Financial Committee just passed 3 crypto bills that will change the entire industry. But are these new laws bullish or bearish for the future of crypto? These legislation process can get complex, and I've gone through the readings so you don't have to. So today, let's break down exactly what to expect for new laws coming to crypto in the US. Welcome back to the Virtual Bacon channel. My name is Dennis. I'm a crypto angel investor for the past 5 years, and I've invested in over 100 crypto startups. On this channel, I share my views on market trends and investing strategy that I use to build wealth with crypto. US laws and regulations always have a huge effect on the crypto industry. The SEC and CFTC's continued overreach and litigation on crypto companies are constantly hurting the US crypto startups. All of the exchanges are also carefully considering which types of coins are considered securities, which directly affects which coins they list for trading. USD stablecoins are also yet to be clearly identified. Are they allowed to exist from questionable entities like Tether USDT? Are US-based issuers completely safe like Circle USDC, or are they securities? Fear not, we are finally making some progress. Just last week, 3 major crypto bills have passed through voting in the US House Financial Services Committee. This is the first time that we've had clear language to propose bills around cryptocurrency in the US and have them pass through the legislative system. Before we review each bill, don't forget to smash the like button and make sure to subscribe for the latest market updates. Okay, the first bill is the Fit for 21st Century Act. FIT stands for Financial Innovation and Technology for the 21st Century Act. This bill aims to create a comprehensive regulatory framework for the issuance and trading of digital assets at the SEC and the CFTC. It also provides clarity on which digital assets are regulated by each agency to allow innovators to build and develop new products with confidence, while also securing key consumer protections for purchasers of digital assets. This is actually a really positive bill. For the longest time, all the industry wanted from the SEC and CFTC is clear guidance and a process to register crypto firms and coin offerings. It's not that we don't want regulation, we just need clarity. And this bill calls for the SEC and the CFTC to establish these guidelines. This bill also highlighted some common myths around crypto, which shows the areas of regulation that they are targeting. Myth number 1, all digital assets other than Bitcoin are securities and should be regulated by the SEC. We've seen the SEC trying to make a case for this time and time again, but clearly this is false. The fact is, not all digital assets are securities. While some digital assets can be offered as part of an investment contract and some may be tokenized, a clear framework for determining when a digital asset is not security is critical. As the SEC, CFTC, and the courts have opined, some digital assets do not have the traditional characteristics of a security and therefore should be considered non-security digital assets. These digital assets cannot be regulated as securities. This is heavily referring to the XRP decision. Lastly, to ensure customers are protected and preserve market integrity, Congress must establish a regulatory framework for the cash or spot trading of digital commodities. As such, the Act establishes a process to permit the secondary market trading of digital commodities which were initially offered as part of an investment contract but are not themselves considered securities. So this is calling for 2 different types of classifications: investment contracts, also known as securities, and commodities, which are not securities. This means for Bitcoin, Ethereum, and probably XRP, which are clearly defined as not securities now, they probably fit into commodities and should be regulated as such by the CFTC instead of the SEC. Fact number 2, the SEC's existing regulatory regime is not designed to accommodate the registration and regulation of digital assets. The SEC has failed to provide the clarity these entities need to operate. Instead, the SEC has used its enforcement authority to regulate the market. This is referring to the fact that we really don't know how to create a coin that is not a security. Instead of having a framework, the SEC just goes and sues different crypto projects and forces a response. This is not okay, and this bill clearly aims to address this. Fact number 3, this legislation aims to update existing securities laws to give the SEC full authority over digital assets that are offered as part of an investment contract. Also, it further updates existing commodities laws to provide the CFTC with legal authority over digital commodity markets. So it still gives the SEC regulation power around securities and the CFTC the power to regulate commodities. There is no loophole to get around, but it's just that we will have full regulatory clarity. This bill is long overdue in the US. We can all agree that the SEC and CFTC are necessary agencies to protect investors against bad actors. However, they have never provided clear guidance on what is or isn't allowed, and only chose to crack down on projects based on their choice. If this act can be passed into law, we will finally have a clear framework for crypto companies to follow in the US. This will help classify which type of coins are considered security or commodity, and the SEC can no longer sue crypto companies by surprise and force them to delist whatever coin they want. Moving on, the second bill that was passed is the Blockchain Regulatory Certainty Act. This bill is very simple. It's aimed to protect the non-custodial crypto services such as wallets, validators, and crypto miners so they don't have to worry about getting a financial license. Listen to their official remarks about this bill.
With state regulations varying on what type of blockchain-related entities qualify as money transmitters, major discrepancies in the state-by-state framework create uncertainty for providers who never have custody of customer funds and, in fact, even provide extra layers of protection for the very consumers that money transmitter laws are designed to protect. To provide a solution, the Blockchain Regulatory Certainty Act codifies existing FinCEN guidance to affirm that non-custodial blockchain developers and service providers, like miners, validators, and wallet providers, that never custody consumer funds do not have to register as a money transmitter.
We have really come a long way to have politicians actually mentioning miners, validators, and wallet providers and how they offer non-custodial services and do not control customer funds, and thus they shouldn't need to register as money transmitters. This is huge. It actually shows they are understanding the industry. I will be curious to see how this bill applies to staking pools, decentralized exchanges, liquidity providers, and other DeFi platforms. With some projects that have an admin key which controls the deposited funds, it's a much harder argument to make. There are fully self-custody platforms like Uniswap that's completely governed by smart contracts, but where do you actually draw the line? This is perhaps why DeFi wasn't mentioned in this bill, but it is a step in the right direction to help the blockchain developers. At least you can make a self-custody wallet software without having to worry about the regulators coming after you. Something else to note, this bill also does not include laws around centralized exchanges, and it won't help us avoid another FTX or Celsius situation. So for now, we still have to rely on the crypto industry itself to provide proof of reserves of customer assets and to protect our own funds by withdrawing early when there is bad signs of a bank run happening. Self-custody is still super important. So to see which wallets I'm using and which ones I think are the safest, check out my top wallets video linked in the description. Next, for the final bill that was passed, this is the biggest one. It's called the Clarity for Stablecoins Act. This is a long-awaited bill that specifically targets USD stablecoins, and it has gone through heated debates for many months. This bill aims to provide a clear regulatory framework for the issuance of payment stablecoins. The bill protects consumers by establishing necessary federal guardrails, while at the same time fostering innovation in the US through a tailored approach for new entrants into the marketplace. So what type of innovations are they talking about? First, let's clarify. This bill is not about adoption of stablecoins for payments, but rather it's targeted at stablecoin issuers. Essentially, it's a direct call to regulate stablecoin issuers like USD Tether, Circle USDC, and many others, and give them a set of rules to follow in order to issue stablecoins. Have a listen to the summary of this bill.
In the peer-to-peer digital economy, people around the world want to transact in dollars in real time using stablecoins. However, this administration's regulatory treatment toward the digital asset ecosystem is killing digital asset business in this country and making it hard for American issuers of US dollar-backed stablecoins to compete globally. So guess where the US dollar stablecoin transaction volume is flowing? It's flowing out of the United States regulatory apparatus and into things like Tether and other foreign-issued US dollar stablecoins. This is a threat to the United States.
But we heard in testimony before this committee from Undersecretary Lang, the Treasury. She says, and I quote, if stablecoins are backed by high-quality assets, the risk is quite low and they can form a building block, a cornerstone of a payment system. We establish a uniform federal floor by providing regulatory requirements that all stablecoin issuers, no matter where they're chartered or licensed, must follow regardless. These requirements are set and enforced by federal regulators. We put strict requirements in place around stablecoin reserves and capital to guard against potential runs. This means payment stablecoins must be backed by at least 1-to-1 with ultra-safe cash and cash equivalents. We ensure transparency and accountability. with respect to these issuers to maintain consumer confidence. That's because we require stablecoin issuers to comply with redemption requirements, monthly disclosures of reserve composition, and Sarbanes-Oxley-like attestations and regular audit.
There's a lot more to unpack there, and Paul Bear Network has a really good video that breaks down this whole stablecoin bill and everything that was decided in the debate. So go watch this video for the full breakdown. So let's summarize all that was mentioned. First, the US House is clearly recognizing the importance of USD stablecoins and how all the crypto transactions are settled with these assets. They really want to capture these volumes. They specifically called out USD Tether as being a foreign issued US dollar stablecoin. This could be bearish for Tether, and it could be one of the reasons we're seeing exchanges like Binance starting to adopt other stablecoins as their main trading pair. Next, they want to establish a federal framework for all stablecoin issuers to follow. There will be strict requirements before you can issue a stablecoin. What are the different requirements? First off, stablecoin issuers must have reserve capital to guard against potential bank runs. Stablecoins must be backed one-to-one by ultra-safe cash and cash equivalent assets. This is interesting, so they are requiring stablecoins to be fully backed one-to-one and backed by cash and not other assets. This means Circle USDC will be the best fitting stablecoin under this guideline. Here is the USDC reserve breakdown. You see, aside from cash, all they have are CDs, US treasuries, commercial paper, corporate bonds, municipal bonds, etc. So these are all considered cash equivalents. However, other stablecoins such as DAI could be under question since they are backed by both stable assets like USDC and cash, but also other volatile assets like Ethereum and even staked Ethereum. So even though DAI has more backing than its supply, it's over one-to-one backing, it still might not be allowed in this framework. The same goes for other DeFi stablecoins like Frax. To maintain consumer confidence, the stablecoin issuers also need to support redemption of the underlying assets and have transparency reports and audits. They also prohibit commingling and rehypothecation of reserves. This means exchanges might have a difficult time issuing their own stablecoins from now on. For instance, Binance's BUSD stablecoin could be under question, and this is probably why we saw them stop minting it, since we don't know which assets are backing the stablecoin and which assets are actually the exchange customer funds. Stablecoin issuers also cannot use the backing assets for other reasons like yield or put them into DeFi. This could be another issue that DeFi stablecoins have to face. After all, a big part of the innovation in DeFi comes from trying to generate as much yield as possible using composability of smart contracts. So this always involves taking the underlying collateral assets and putting them into other ways to earn yield. This might not be allowed under this framework. Now, I know the government often just say they are doing things to protect the customer, but personally, I think this stablecoin bill is really well designed. Stablecoins present a huge risk to the crypto industry, especially to the beginners, as there are many nefarious actors that siphon out the money. Some designs that rely on algorithms to control the price are also way too risky to be considered stable. I'm looking at Luna and USD. For inexperienced investors, it's really hard to tell which stablecoins are safe to use today. Many of them have the USD name in their ticker to convey a false sense of security. But in practice, many of these USD stablecoins have gone completely off peg over the past couple years. So this stablecoin framework can help us take away all the risk and actually choose the stablecoins that is safe and fully backed by cash. In the short term, however, this could pose some serious questions for existing USD stablecoins, especially for Tether USDT. This has been one of the biggest looming risks in crypto. Will Tether continue to be allowed to operate? Maybe exchanges will choose to not use it as the default stablecoin anymore, and maybe they will adopt some other regulated choice by the government. This will definitely shift the industry, as the USD Tether is still by far the most dominant stablecoin used on all exchanges. Okay, lastly, here are the key takeaways. These three bills, in my opinion, are all pro-crypto. They are aiming to establish frameworks in key areas of crypto that have been attacked by the regulators through litigation. And the fact that there are real bills being pushed to the US House now is a huge step forward for the crypto industry. The legislators are actually discussing which coins are securities, who makes these rules, stablecoins, miners, validators, etc. We've finally gone past the stage of dismissing crypto as a scam industry, and the government is taking notice on the importance of our industry. Last thing to note, these 3 bills are still in the very early stages of the legislative process. They have passed the House Financial Services Committee, which is only a small work group within the US House Representatives. The next step is for this bill to actually go to the House floor to be voted. Then the bill will be passed to the Senate and go through the same process. Lastly, it will go through the President and be passed as law. This is a great first step to see support for these bills and getting them passed in the first part of the process, but not all of these bills will be made into law for sure. We will continue to cover new crypto bills in the US on our channel, and I think they will be especially important leading into the elections next year. Crypto will be one of the hot areas in the new presidential campaigns, and by then we can really start to see some hard laws being passed for the industry. Okay, that wraps up today's video. If you like this content, make sure to follow me on Twitter at virtualbacon0x and join our Telegram alerts channel just at virtualbacon. I share a lot more unfiltered crypto alpha on Twitter that are too quick for these in-depth videos. And in our Telegram alerts channel, we just launched our Crypto Bits, which covers all of the most important news headlines in crypto every day. If you have any more questions about these US crypto laws, join our live stream every Monday by subscribing to the channel and turning on notification. You can ask me any question you want on the live stream. Don't forget to subscribe and share this video with a friend. Thanks for watching and see you in the next video.